So we started in 2017 was when we broke even and then hit our hockey stick. That year, crypto took off, Bitcoin, and we were the first public asset manager to give our clients exposure to Bitcoin through GBTC, which was a grantor trust at the time. And Bitcoin in 2017 went from less than $1,000 to $20,000 by the end of the year. And so that many people had in 2015, when we first put it in the portfolio, dismissed it as a marketing gimmick. Many in the ETF space, because we had just started, oh, right, marketing gimmick. But it wasn't. In fact, the more I heard that, I said, oh my goodness, nobody really understands how big this is going to become.
In 2015, adding Bitcoin to a portfolio was considered reckless by many on Wall Street. Cathie Wood, founder and CEO of Ark Invest, remembers how even seasoned ETF managers mocked it as nothing more than a marketing ploy. But the louder the skepticism, the more convinced she became that they were missing the magnitude of what was unfolding. Bitcoin wasn't a gimmick. It was the foundation of a new asset class. Today, Wood sees another story developing. The stock market, despite headlines warning of weakness, is climbing what she calls the wall of worry. That phrase describes a bull market that pushes higher even as doubts pile up. The important detail is that the rally is broadening beyond just the mega-cap tech giants. When leadership expands across sectors, it signals strength under the surface, a healthier, more sustainable bull market. She also challenges the popular narrative of American decline. Many point to the dollar's sharp drop this year, the steepest since 1973, as evidence the U.S. is losing its edge. Wood sees it differently. Lower effective taxes, deregulation, and improving returns on invested capital are positioning America more favorably than its peers. That dynamic supports both the dollar and U.S. markets. In her view, the resilience is not a mirage but a sign of real underlying strength. If you found value in this breakdown, please hit the like button, subscribe, and share it with other investors who are paying attention. We're here to keep bringing you sharp analysis and voices that actually understand what's unfolding. Thanks for watching.
2017 was critical, I think. So we started in 2017 was when we broke even and then hit our hockey stick. That year, crypto took off, Bitcoin. And we were the first public asset manager to give our clients exposure to Bitcoin through GBTC, which was a grantor trust at the time. And Bitcoin in 2017 went from less than $1,000 to $20,000 by the end of the year. And so that many people had in 2015, when we first put it in the portfolio, dismissed it as a marketing gimmick. Many in the ETF space, because we had just started, oh, right, marketing gimmick. But it wasn't. In fact, the more I heard that, I said, oh my goodness, nobody really understands how big this is going to become. We're listening to the markets as well. This market, the stock market, is climbing the proverbial wall of worry. And it is broadening out. In fact, that concentration towards the Mag 6 is starting to broaden out. That's a very strong bull market. Now, why is this happening? Yes, the headlines blare negative news, as you say. It seems to get a lot more attention. If you look under the covers, at least in the United States, there are some provocative changes taking place in terms of deregulation. I don't think people understand how much deregulation is taking place in the U.S. In every industry, and then the one big beautiful bill, OB3, we've nicknamed it OB3. Underneath those covers are tax cuts that I don't think many people, even in the United States, understand, because they're mostly focused on the corporate sector, and they're allowing full expensing of structures, equipment, domestic R&D, and software in year one, first year of service. That is taking the effective tax rate in the United States from 21%, where it is today. This is effective. It'll still be there.
This is corporate tax rates.
This is corporate tax rates, 21% down to 10. So it's in the 10 to 12% range. Some of the lowest in the world. And so you hear a lot of people saying, okay, American exceptionalism is dead. The dollar's demise is upon us. And first half of the year, biggest decline in the dollar since 1973. That was all true. But we believe that the return on invested capital in the United States, because of the direct deregulation and tax changes, return on invested capital in the United States is going to increase relative to that in the rest of the world. That's dollar positive. That is dollar positive. So I think that's why the markets are powering forward in the U.S. I think many investors in the United States are very focused on the short term. And the short term means they want their profits now, their dividends now, their share repurchases now. Companies very focused on innovation are actually sacrificing short-term profitability in order to capitalize on these massive opportunities. That's what we do. So if you're asking me that question, yes, I think there's too much focus on the very short term. Our investment time horizon is 5 years. And when it comes to valuation, we make the assumption that whatever premium to the market our portfolios are valued at now, that premium to the market is going to compress towards a market multiple within 5 years. So we are looking at valuation as a headwind for us in the next 5 years. And our analysts have to believe that the revenue growth and margin expansion in the portfolios and associated with each stock are going to be strong enough to overwhelm the valuation compression and deliver our investors a minimum hurdle rate of return of 15% at a compound annual rate.
Cathie Wood highlights a simple but powerful truth. Founder-led companies drive innovation in a way that traditional corporate structures often cannot. When someone starts a company, they set the culture, the standards, and the urgency from the very beginning. If that leader is a true visionary with uncompromising standards, the entire organization reflects it. Wood argues that this kind of leadership is most important during periods of rapid technological change. In stable times, managing by consensus may keep things running smoothly, but during a revolution, it often slows progress to a crawl. That's why she aligns with the views of Elon Musk and Mark Zuckerberg. Bold leadership is essential when the pace of innovation is accelerating. Wood also turns her attention to the AI race. NVIDIA has long been the leader in GPUs, effectively owning the AI hardware space. Their dominance is clear, but it doesn't mean competition has stopped. AMD continues to innovate aggressively, pushing forward with its own breakthroughs. Even Tesla is entering the field, developing an in-house chip that Elon Musk believes could rival NVIDIA's top offerings within a few years. For Wood, this competitive pressure isn't a weakness. It's exactly what fuels the kind of innovation investors should be watching closely. Let's get back to the interview.
I think what we're learning about innovation is founder-led companies are very important. I know this from my own, setting up my own company. You set the culture, you set the standards, and as long as the leader is a visionary leader with high standards and drive, that's the kind of company you want for, especially now, all of the innovation that's taking place in such a short period of time. Managing by consensus is fine when the world isn't changing at a rapid rate. Consensus is what many people are really saying when they say governance, right? I think I'm going to agree with Elon and Mark Zuckerberg on this one, given where we are. We've never been in a technology revolution like this one. So Figma, if people know Adobe in the design space, They probably know Figma as well. Figma introduced collaborative design and leapfrogged Adobe. So that's why we own it. The world is moving into a more collaborative mode. We know from our own businesses, what would we do without, whether it's Slack or Teams or what have you. So that's the same thing in the design space.
Why do you own AMD but not NVIDIA?
Well, we do own NVIDIA. It's a much smaller position. The valuation is much different. AMD has had a lot of practice competing with both NVIDIA and Intel. It competed with NVIDIA in the gaming space successfully, gained share in that space, and in Intel in the CPU space. And we see what's happened to Intel, and that's giving AMD even more running room to increase its share of the CPU space. I think NVIDIA is, the innovator in the GPU space, and even recently with Rubin, we're seeing, oh yes, another innovation that AMD will have to copy. There is a lot more competition, though, besides AMD. Tesla believes it will have a competitor chip to NVIDIA's best this time next year or early 27. And I think Elon's confidence in that has gone up. So NVIDIA has been in the generalized AI space extremely effective, number one. I think there are going to be more specialized players that come in and usurp some of the role, and NVIDIA is trying to address that as well. Tesla is going to be the largest robotics manufacturer. Now, why are we saying that? Tesla already, with robotaxis, is in the robotics space. So autonomous vehicles are robots. They will be electric, and they will be powered by AI. That's a robotaxi. That is also a humanoid robot. So it's already expert at the convergence among these technologies in a way that no one else is, very few. Elon says he believes that Tesla will be number one globally in humanoid robots. That's going to be a $26 trillion market. We agree with him. But he also says the next 9 players are in China. We don't know if that's completely true. We've got Figure AI in our venture fund, but we are amazed at how quickly China is moving, and it has such a big demographic problem that it is imperative that it moves in this way. So we think Tesla will be number one. Another player is Teradyne. It bought a European company, a Danish company called Universal Robots that's starting to work with Amazon now. So you're right. There aren't that many pure play robotics manufacturers. And we saw this in 3D printing as well, automation. The industrial sector tends to gobble those companies up or compete against them. And so maybe that's why this is happening this way. 2 years ago, almost exactly, we bought a company called Rise, R-I-Z-E, and they have just done an amazing job throughout the UK and Europe. And in fact, I think we just hit $1 billion today.
Of your ETFs in London?
Yes, the listed ones in London. So ARKK, ARKI, and ARKG. So flagship artificial intelligence and robotics, which is a new fund. We don't have this one in the U.S. And I think genomics is what they call it. We call it multiomics in the U.S.
Skepticism has always been the backdrop for breakthrough ideas, yet the same doubts that once surrounded Bitcoin now echo across today's innovation cycle. Markets are climbing despite constant warnings, and the broadening participation suggests deeper resilience than critics admit. At the same time, the companies setting the pace aren't just following playbooks, they're led by founders willing to make bets most managers wouldn't dare. That kind of conviction matters when entire industries are being reshaped, from digital assets to artificial intelligence. Competition among giants like NVIDIA, AMD, and even Tesla shows that no lead is permanent, and pressure from rivals often sparks the boldest advances. The thread running through it all is vision, the ability to see past today's fears and build for tomorrow. With that in mind, the real question is whether investors and institutions are prepared to back leaders and technologies that defy convention, or if they'll hesitate until the opportunities have already passed them by. So stay tuned. If you're into real, data-backed takes on the financial system, hit like and subscribe so you don't miss the weekly updates. Thank you for the support, and I hope you enjoy the video.